Very good evening to our audience today. Thank you very much for spending your evening here with us. My name is Justin. I'm from PhillipCapital Partnership Department, and I'm your host for today's episode of Ask Me Anything webinar series. So let's find out what to look out for when you're investing in unit trusts. So are you new to investing in unit trusts? Are you wanting to know how you can start investing in unit trusts? As we are in a digital age today, right? I think everyone knows that information is right at our fingertips, and we can find what we are looking for through simply Googling it on our phones. However, despite the large amounts of information out there, unit trust investing can still be complex and daunting, especially for first-timers. So what are some of the factors that we should look out for when investing in unit trusts? What are the options available for you? I'm sure everyone has burning questions. May I request that you plan your questions because our session must end in 1 hour, including our Q&A. So if you have any questions, do put in. You are welcome to put into the Q&A function, the Q&A part, anytime throughout the webinar. As for the audience, we are actually live on Zoom and Facebook. So before I introduce my guest tonight, I must assure all of you here tonight that there will be no selling during tonight's webinar. It is completely educational. And if you are watching us, please share with your other friends who you think that they can benefit also from this fireside chat, where they can ask all your questions about investing in unit trust live to our financial specialists. Yeah. Okay. Okay. I'm quite honored to introduce 3 of our financial specialists tonight. So let's hear from them about what do they have to say about putting their trust in unit trusts. So tonight we have 2 Darrens actually, but first one we have Darren Ng, who is Financial Services Director with Phillip with us, and we have Elijah Lee, Financial Services Manager with us, and we also have a very special guest here tonight with us for this Ask Me Anything episode. So joining us tonight is Darren Ng, Business Development Manager from Schroders, Singapore. So let's hear it from them. Yeah. Okay, so let me introduce our speakers for tonight. Today, let's start with Darren Ng. So Darren is a veteran in the financial services industry with over 18 years of experience, and he has bagged numerous awards. And what I know about Darren is that he is very passionate about sharing his knowledge and experience, as not only is he a financial services director with us, but he also does financial education courses. So hi Darren, would you like to share something about yourself with the audience?
Okay. Thank you, Justin, and good evening to everybody. Thank you for taking time to attend this webinar. Okay. I'm Darren Ng here, and as Justin said, I've been over 18 years in this industry. Before that, I was an engineer, and I worked as an engineer for 10 years before I come to this industry. And I'm also a trainer for 2 IBF accredited programs that focusing on generating passive income and also on risk investment. Okay. My team actually operate the investor center at Westgate Tower. So I think some of you may be our Jurong East client. So you happen to be at Westgate Mall, or you go to the blood bank that's located at Westgate Tower level 10, which is opposite our investor center to donate blood. Okay, you can just feel free to drop by our center for a free massage, as we have an OC massage chair actually in our investor center that's underutilized. Okay, back to today's session. I hope that by sharing my knowledge and industrial experience with you tonight, we're able to help you to make a more informed decisions and invest better in the current market situation.
Thanks, Darren. Okay, thanks, Darren. I think that the Westgate branch is actually very nicely done. So if you guys haven't been there, check it out. I think they'll be more than welcome to let you in for a cup of coffee. Yeah. Next we have Elijah. So Elijah is definitely no stranger to sharing his knowledge and views with the public. He has been interviewed many times on local media channels such as radio stations and news publications. So hi Elijah, could you maybe share with us a bit of that or anything else that you'd like to share with our audience today about yourself?
Sure. Hi, good evening everyone. Thank you Justin for introducing me, and thanks for making time to come to tonight's webinar. I'm Elijah, and I'm a financial services manager with Phillip Securities. I have been working in Phillip for the past 6 years, but personally, I've been investing for over 10 years. So some of you may have read my answers on personal finance questions on the Phillip platform, or like Justin mentioned, you may have heard me on the radio on Money 89.3 FM, and perhaps even read my interviews on Straits Times. Actually, I'm also with the Westgate team, so that's where I often meet my clients as well. Yeah. So hopefully my sharing tonight will be able to help you understand unit trust better so that you can invest with confidence, even in a market situation like what we are experiencing today. Thank you.
Thanks, Elijah. Okay, next we have, last but not least, let's welcome our special guest speaker for the evening. We have Darren Ng. So I'm sure many of you are familiar with Schroders, but just for the benefit of those who haven't heard of them, Schroders Singapore operates as an asset management company. The company provides wealth management, fixed income consulting, many other investment services, and are serving customers worldwide. So hi, Darren. Is there anything that you'd like to share about the audience? Share about yourself with the audience. Sorry.
Hey, thanks, Justin, and very good evening to everybody on the call. This is Darren here, and firstly, thank you all for your time. Please keep those questions coming, and I think all questions are good. It's just going to help everyone on the call. But thank you for your time. I also want to thank PhillipCapital as well and the team for having me here tonight. My role as business development manager at Schroders, I think rather than sharing more about me, I just want to quickly add on to what Justin has shared. Yeah, so Schroders, we are a fund house. That's what we are known as well, or asset manager. But Schroders is a firm that has more than 200 years of history. And even in Singapore, we've been operating since the mid-1970s, one of the first few fund houses to be operating here. So I think we have a pretty good idea. Schroders, we also have we actually provide the largest number of CPF approved funds available. And so really look forward to a lively discussion with Justin and my experienced panelists today. Back to you, Justin.
Thank you, Darren. Okay, so all right, that's the introduction of my special guest tonight. So at this junction, let's get our audience tuning in to do a little poll. I will flash and read out the poll. If you're on Facebook, you can comment in the chat box your answer. If you're on Zoom, just simply click on the answer, and we shall wait 1 or 2 minutes to get to know a little about our audience today. Okay, we'll wait a little while more. Oh, we have some no's. Okay. 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 So let's share some of the results. The majority said yes, they have experience. So it seems we have quite an experienced audience tonight, but we also have a few number of beginners tonight. So when it comes to investing in unit trust, maybe some might have the experience, but are not entirely sure if they are getting the full picture and are doing it right. So let's hear from our speakers tonight. Yeah. Okay. So let's start off with our first question of the evening. What are unit trusts exactly? So maybe Darren, you want to start? Darren Chiu, you would like to start? Yeah.
Okay, thank you, Justin. Okay, for those that are actually, there's quite a number of you are quite new to unit trust. Okay, maybe just summarize what actually unit trust is. A unit trust actually is called a collective investment scheme. We call it CIS for shorts. Just like REITs also actually consider a collective investment scheme. So what does that mean? That means that usually you involve you passing your money over to a professional money managers for them to invest for you. Okay. So this money manager, we call them a unit trust fund manager, or some people call them fund managers. They can only invest in liquid assets. Just like they can invest in the stocks, bonds, and they can even invest in futures or even other derivatives. Okay. So unit trust, there's always a misconception that unit trust is low risk. Actually, unit trust, it can be considered as a high risk investment product, as the risk spectrum is very wide. Okay, and you may suffer big losses if you never do a proper portfolio allocation. Okay. Back to you, Justin.
Elijah, Darren, you want any of you want to go next? Yeah.
Yeah, maybe let me just add on a bit. So as mentioned, unit trust managers actually invest in various assets, right? So unit trusts definitely have that ability to let you get the kind of broad diversification that you're looking for over multiple assets. But something that actually a lot of investors don't know is actually you can get started with really a very small amount. So for example, most funds, getting started with $1,000 is actually quite normal. That's like the smallest investment amount that you can get started with. But then there are also some unit trusts out there that actually let you start your investment with even smaller amounts like $500. And there are even some funds that allow you to get started with just $1. So this is not something I think that you can find with other asset classes. For example, if you want to buy, say, bank stocks, DBS, $30 plus per share, you need at least $3,000 to get the minimum of 100 shares, right? So unit trusts, you don't really have this problem. And also, unit trusts actually do offer you access to markets that you might not otherwise be able to invest in directly, for example, like foreign markets. And that is something that I find that unit trust has that unique edge. Yeah.
Yeah, adding on to Elijah, I think there's a very good point on foreign markets, and sometimes I think it is about investing. Unit trust will give you access to markets you may not want to spend time to invest. Example, well, we can all invest in US stocks very easily. Not all of us want to stay up late at night watching the US markets, placing our trades. So that's where sort of unit trust you pass over the investment responsibility to investment managers and professionals to sort of do the allocation. I also just want to add on to Darren Chew's point earlier. Yes, so the main thing to highlight is unit trusts. These are investments. They are not capital or principal guaranteed. And they're going to be exposed by risk, because what unit trusts invest in would be stocks or bonds. So if there's going to be price fluctuations, these will affect the price of the unit trust, and typically this is what we call market risk. I'm just looking at a very quick question that's been raised. So the question is saying unit trusts have both fund assets and share class assets. What are the differences? So example is they're in different currencies. And I think that's a very good point, because another risk for unit trust will be foreign currency risk. Because if you are investing in unit trust, example, let's say it's investing in the US, you expect everything to be denominated in US dollars, but the unit trust itself could be a Sing dollar share class, and there could be a foreign currency difference between the two. But also adding on, that's where you also find these days very common, there are hedge share classes, foreign currency hedge share classes. This really tries to minimize the impact of foreign currency differences. Yeah, so hopefully that just gives you a quick overview. Back to you, Justin.
Hey, thank you, speakers. Thanks, Darren. Okay, let's see. I think to highlight what Elijah really shared, I think a lot of beginners tonight, and maybe even like myself, actually do not know that you can start investing in UT even with just $1. So I think that really brings me to the next question. So what are the common misconceptions that investors have of unit trust? Maybe Elijah, you would like to start, whether you have any clients that or whoever have a lot of misconceptions of unit trust. Yeah.
Okay, sure. So actually one of the most common misconceptions I heard about is actually underperformance. So this is actually with respect to underperformance relative to the index. It is actually a very big misconception that I find, because it really depends on which unit trust and which market you are looking at, right? So, for example, right, in Singapore, one of the most popular investments that I hear a lot of my clients talk about is actually your STI ETF. So that's actually very popular with your local investors. But actually, if you compare some of the Singapore equity-focused unit trusts, right, they actually outperform the STI ETF, and we're talking about outperformance over periods of 3 or 5 years or more. So the fact is actually STI ETF has been underperforming Singapore unit trust, and I think that says quite a lot, right? So it isn't always true that unit trusts underperform all the time. While there are such examples of that, there are also examples of unit trusts that do outperform their respective indexes. So it's not as gloomy as it seems to be. Yeah.
What about the two Darrens? Anything to add to Elijah's?
Maybe I'll just add on.
Sure.
On that first. Okay, because that when it comes to unit trust investment, a lot of new investors have misconception, because they say I pass my money to money managers, who is a professional when they invest for me. they're supposed to make money for them. So to them, there's a misconception that unit trust will guarantee or definitely make money regardless of market conditions. But you have to take note that unit trust actually invest in the stocks and the bonds market. Okay, so if the overall market is down just like currently now, okay, you should not really expect your unit trust to be positive. Most of the unit trust should be negative at this juncture, because they are actually, the fund manager are actually investing in stocks and bonds also, and even bonds, a lot of people think that it's low risk, and in fact, because of interest rate rise, most of the bond fund actually are currently giving negative returns. Okay, so that is a common misconception. So now we are looking at, when you come to look at unit trust, actually you should look at the percentage of the fund performance up or down relative to the market, as what Elijah said, if compared to the market. Then this is how you differentiate whether is the unit trust being well managed by a good fund manager or not so ideal fund managers. Darren, maybe you want to add on that?
Yeah, thanks. I think I'll move away from performance. I think that's definitely a big misconception. But maybe another thing about maybe for newer investors especially is there are fees involved with unit trust investing, right? There's typically it could be upfront fee, and typically you have an annual management fee. So the thing about annual management fee, when you look at unit trust and you look at some of the reported performance figures in your fact sheets, you don't need to deduct the management fee from these performance figures anymore. So that's also where, in the world of unit trust, the price of a unit trust, we call it NAV, or net asset value. So why we call it net asset value is because we actually deduct, it's already less of all these annual management fees. So example, let's say if a fund's annual management fee is 1%, and what is shown on the fact sheet is, okay, historical performance is 5%. You don't need to take 5% minus 1 anymore. The 5% factors in that management fee. So this is also where it is transparent for unit trusts. And actually, well, you tend to hear another misconception is that our unit trust fees are very high. Actually, it's all very transparent, and it's already reflected in some of these historical figures. Yeah, thank you.
Great. Okay, I think after hearing from our speakers, right, maybe maybe later, we'll share more, and some of us will start maybe looking at unit trust in a slightly different light. So, however, I think that some of us might still have this belief that unit trusts actually usually mean higher costs, as they generally incur higher management fees than other passively managed ones. So maybe can our speakers share about that with us? Yeah.
Maybe let me go first, since
okay, sure,
I'm from Schroders, of course, and I'm the fund house. So probably investors are probably very like thinking, wow, yeah, why Schroders? Why your fee so high? What we want to do is really to create value for investors, but at the same time, there are fees involved. But when we typically look at annual management fee, that can be a range, that can be a variance, depending on the different type of funds as well. So as Darren Chu and Elijah have shared, there's really a wide universe. There's many different types of unit trusts, right? So at Schroders at least, and typically in the industry, funds that have higher fees also tends to correspond to the value add, or sometimes it's some of the complexity, the amount of analysis that applies to the strategy. So what I mean by this is, example, if it's a very actively managed fund where the portfolio manager makes a lot of trades, then your annual management fee typically is going to be a little bit higher because your fund manager is doing a lot of things for you, right? But maybe let's say if I go to the other end of the spectrum, a fund that is buying into money market or Singapore bonds. So these are funds where you don't really do much in a sense, because you're buying very straightforward instruments. There's not much value add for the fund manager also today I buy something, tomorrow I sell something, right? It's maybe a little bit more buy and hold. Then some of these annual management fees can be quite low. It can be even like 0.5%, right? So I think that's where there is really going to be a wide spectrum of fees. It's more important for you, I think, for any investor to be aware that there is this fee, and then why is sort of different for different strategies. Thanks.
How about Darren Chiu, Elijah? You have anything to add to unit trust really meaning higher costings?
Okay, maybe I'll just answer this. Okay, actually, you have to. A lot of people say higher cost. Then I always ask depend on what are you comparing it to. Okay, there is always no free lunch when it comes to investing. So if you were to pass someone to engage a team of professionals to help to manage the investment for you, definitely you need to pay them. Okay, definitely pay them because nobody will work for you for free. Just like you invest in REITs, right? You also pay the risk manager management fees. Okay, but the risk share price come down, you blame the risk manager for the share price coming down. So then there's another fee that a lot of people have misconception. They talk about sales charge. Okay, they thought that it is imposed by the fund manager. Actually, they charge me 5% sales charge, 4% sales charge, charged by the sales fund manager. No, actually, this sales charge never go into the fund house pocket at all. Okay, it go to the person that sell you the fund instead. So task and sales charge, it can range from 0 to 5% for buying the same fund. So depend on which platform you use to invest on your interest. You're buying the same thing, but there's platform that don't charge you any fees, but there's platform that charge you something. So this is called it the external fee. So this is where you can bring your cost down by looking for platform that don't really charge you. But of course, you want people to advise you, to recommend you, then definitely the person need to earn something from you. Okay. Maybe Elijah, you want to add on further on that?
Yeah, so I think I just had to add on something about the cost. You have to remember what you're paying for when it comes to cost, right? So generally, we do see that, of course, unit trusts have higher costs than ETFs, for example, but that's because operationally, they are not as straightforward as an ETF, right? So your typical fund management team will have to perform things like research, they have to travel to meet company management, they have back-end costs, so on and so forth, right? So all these costs do add up. And one thing I can share is that actually my wife works in a fund house as a assistant portfolio manager. So there are really a lot of costs. I can't say too much, but there are, right? So of course, it must translate, right, to better performance than the market, right, after the cost. So when we are looking at returns, for example, right, costs, yes, they do affect your returns, but let's say net of the cost, as Darren Ng mentioned, right, if it's already better than your benchmark, then wasn't that actually already worth it, right? So that's just something I like to highlight here. Yeah.
Thanks, Elijah. Yeah, so I see. So while we are paying for management fees, right, we also have to bear in mind that, this is due to the higher amount of time and expertise required in rebalancing our portfolios regularly, and, which will be worth it if it translates to positive returns. Yeah, okay. Before we move on to the next question, maybe let's do another poll. I will flash and read out the poll. If you're on Facebook, can comment in chat box your answer. If you're on Zoom, just simply click on the answer. Okay. Yeah, we will wait 1 to 2 minutes. Yeah. Okay, we'll wait a while more. Come on. Okay. Okay, we have a majority choosing ETF and then followed by not sure and lastly unit trust. So actually for me, I also belong to the not sure group. So let's find out as we continue with the questions then. Yeah. Let's go to the next question. So yeah, a lot of us actually get confused by ETF, exchange traded funds, and unit trusts, also known as mutual funds, because they both offer diversified exposures to the market. So we also have a question in the Q&A from Isaac. What is the difference between UT and ETF? So he also has the same question. What exactly are the ETFs? How do they differ from unit trusts? What are the key differences? So maybe our speakers would like to share. Yeah. Who would like to go first?
Maybe I'll take this question first.
Okay, thanks, Darren.
ETF actually is a relatively new product. Okay, when compared to unit trust, ETF actually have a history of only about 30 years. Okay, in the 90s, ETF will then start to come out in the market, but unit trusts have been in the market for a few hundred years. Okay, so what is actually ETF? ETF have both the feature of a stocks and a unit trust. Okay, that means you can call it a diversified fund that you can trade like a stocks, because when market open, you can buy and sell your ETF. That means you can just take it as the stocks and shares and buy and sell it. But they are also fund managers. Okay, but the ETF have a fund manager. Actually, they buy a basket of stock for you. Okay, and so this is what actually ETF is. But for unit trust, it is usually actively managed compared to ETF. Usually, is more passively managed because they just buy the index. Okay, and they don't really need to manage it because this is what the index tells them to buy. Okay, but the unit trust is more actively managed by the fund managers, and you can't actively trade it as there is only one price per day lah. So you cannot say I buy and sell unit trust like stocks or ETF on a regular basis. So this is one of the main basic difference between an ETF and unit trust. So the rest I'll leave it to the other two of them to elaborate further.
Maybe I just add on here. So typically, ETFs, right, they have a benchmark that they track against. So for example, STI ETF, it will be tracking the STI, right? So the whole goal of such an ETF, right, is to replicate that benchmark as closely as possible, right? So that means that even if it has to hold on to, for example, stocks that are not performing well, just because the stock is already a part of the benchmark, then they have to hold on to it. If not, it's not really a benchmark that it's not really tracking, right, the benchmark. So in the case of unit trust, right, this is actually not the same. Okay, unit trusts are actually allowed to deviate from the benchmark in search of that better returns, you know, or in search of, say, for example, similar returns but lower risk. Okay, so is this deviation, right, from the benchmark whereby the outperformance can occur if the fund manager makes the right decisions and also the right allocations to, you know, the holdings inside the unit trust. Yeah. So that's something that I think is quite important to take note. Darren, anything to add?
Yeah, I think it's also how you sort of access these two instruments, just like what Darren said. ETF is a mixture of stocks as well as unit trusts. So for ETFs, as the name suggests, you can buy it like a share. You can buy it sort of through a stock trading account. For unit trust, is typically through, in Singapore context, you can go through poems, you can go through your financial advisor, insurance agents, banks. So it's also sort of a different sort of access. But I think Darren Chiu put it very aptly. It's about active versus passive. At Schroders, we are focused on fundamental. We're focused on, we are bottom up. We're active managers. That's really our bread and butter, and that's really where we also sort of want to try to add value. But saying that, there is even within our strategies, some of our strategies we use ETFs as well. So it's not like at a fund house, you know, we just move away from it. And I would say the lines are getting a bit blurred. So while Elijah has shared, ETF typically does tracking, and I think that's how it started. ETF gives you like the index performance, like or Straits Times index. But you also find ETFs are getting more and more complicated. There are ETFs that give you, they short the market, they go the opposite direction, they have different type of derivatives, and you'll be surprised. Actually, some ETFs, the expense ratios or the cost can be 10%. So it's not necessarily true all ETFs are lower cost, right? There is also getting, you know, you're getting a lot more options, more complicated in a sense, more interesting sort of investment strategies. So it comes back to choice. But I think from Schroders, the proposition we want to give is long story short, is that just like what Elijah shared earlier also, is we are always trying to outperform the market. Because if you're gonna just deliver what the market is giving, then yes, possibly you're better off investing in ETF. But then that's why our funds, I think that's the minimum that we're looking at. We want to outperform the market. Thanks.
Thank you. Thanks, speakers. I think from that whole sharing, we can really tell that, you know, there are really differentiating factors between UT and ETFs. There's no right or wrong which is better per se. So some people prefer UT, some people prefer ETFs, just like the poll that we did earlier. But I think what is important is that it's very important for us to know what are the differentiating factors, what do they mean for our own investment strategies. Yeah, so we can move on to the next question. Now that, you know, we have some knowledge on UT, I think that the next question on our minds is, so how do I start? Yeah, let's say I'm a client, or some potential client come into the Westgate branch. I say, hi Darren, hi Elijah, I want to start. So how do I start? Yeah.
Okay, maybe let me take this one first. So of course, to start, you need to have an investment platform which allow you to access unit trust, right? So of course, for example, Poems is one of the platforms that you can buy unit trust on. So you must have an account first. So you just have the account already, and then after that, you need to pass what we call the Customer Knowledge Assessment, or CKA, and then actually you can start to invest in unit trust. But of course, you have to do your own research and due diligence before purchasing. That's assuming that you're investing on your own. You wish to do the research on your own and make the decisions on your own. Okay, so another option, of course, is, for example, for those who are busier, if you want to invest with the help of an advisor, then of course you need to speak to an advisor who can help you to craft the portfolio and also help you to manage it according to your needs, risks, and time horizon. Okay, but one thing I want to highlight is that, of course, in particular, when it comes to, say, CPF monies, investing CPF monies in unit trust, you first need to pass what we call the CPF Investment Scheme Self-Awareness Questionnaire. And then additionally, for CPF OA money, right, you will have to open a CPF investment account with a local bank first, and then link it to your investment platform before you can invest your CPF monies in unit trust. Yeah. So that's basically how you get started. Yeah.
Okay, maybe I'll just add on that. When it comes to how do I start investing in unit trust, actually I'll ask the client, another question is, are you able to stomach losses? Because many investors always think that unit trust, when they come to invest, they only unit trust. They think when it comes to invest, they only think of making money. But they never understand that their appetite for short-term losses, especially like current market juncture or like the COVID period, where I see investors invest in the next day market crash and they become panic and they just sell at the lowest price. So I would suggest that not only on unit trust, when you invest, you should do a proper asset allocation. That means you need to know what actually you have. And you see, I actually consider asset allocation as one type called promise-based asset allocation. For example, like T-bills, Singapore government, that one is guaranteed. But another one is called risk-based asset, which is actually unit trust is considered one of the category of that. And also when you want to start, always start small and start slow. That means don't take in one lump sum 50,000, just straight go inside and just buy a unit trust. I would actually recommend you may want to start slowly, divide this money slowly, and maybe you want to do dollar cost averaging. Just like go to a lake, you don't straight jump into the water without testing the depth, and also don't know what is underlying. Because that would be too risky to do that.
Yeah,
maybe
and
Darren,
also
you want to add more? Yeah.
Must test the temperature also. Maybe the water very cold.
Yeah, correct.
I guess you guys have both covered it. I probably just want to share one place you can't buy or start investing in unit trust is through Schroders directly. So please don't call my office and my hotline. We aren't able to do that. So we work with intermediary partners such as Phillips, such as partners like Darren's team. We also work with banks and insurers. There's really a lot of channels available. But yeah, I think coming back to this question, how do I start? I think is about thinking, do you also want to, getting the right advice, I think is very, very important. If you want to go on it alone, DIY, the options are all there. But yeah, just make sure you are clear, do your homework and before you get started. Yeah, thanks.
Okay, so that's for our beginners. There you have it. You have heard from our speakers. So yeah, maybe you hope you get a rough idea on how you can start investing in unit trust. Yeah. Okay. At this juncture, let's do okay. So okay, so how should we as investors go about when selecting a unit trust for our investment needs? I think, yeah, so any of our speakers would like to start from here?
Maybe I'll take this first. Okay, so when you want to invest in unit trust, I always advocate that track record is very, very important. Okay, so you must invest in something that have a proven track record. a lot of investors have the mentality of IPO mentality. When they see a new fund launch, they always think, oh, that one is a new fund, so must be good because it's just an IPO. I buy the next day, market go up, it go up. And in fact, it is not this way. Similar for ETF. The new launch is not based on market. Okay, because they will actually buy the stock price at current market price. So it may go up and go down. And furthermore, a new fund don't have track record. You don't even know whether the fund manager can perform 3 to 5 years down the road. So you see, I don't advocate people to buy new fund. You should buy fund that have been in the market for a while. Best that if they've been to a big market downturn, you see how the fund manager perform during the downturn and how they recover back. So you see a 3 to 5 year good track record, it is very important. And also we also look at their performance against our benchmark. Are they better than the market or are they worse than the market? So if they're better than the market, of course, that will be the fund that I will shortlist them on that. And the last part is that they must be constantly ranked among the best when compared to their peers. Like for example, Asia Pacific Fund, there's actually more than 10 Asia Pacific Fund, but the performance may vary. So you may want to compare them 3 years, 5 years, 10 years, which fund actually constantly rank among the top. They may not be the number 1 throughout, but they may be in the top 3 throughout. So these are what, when you want to look at unit trust, this may be one of the good references you can look at on that.
Maybe I'd like to add on one key factor that I find that a lot of investors tend to forget about is actually risk. So you actually don't want to take on proportionally more risk to squeeze out an in-proportionate amount of returns. For example, like just to squeeze out 1 extra % of return, you double your risk. I don't really think that's worth it, because it may actually give you a lot of sleepless nights, right? So the thing is, it's natural that as investors, we want to have the best return, okay? But sometimes taking on too much risk is unlikely to be the best way to get that. You may end up making decisions based on emotions, especially when the market is down, right? So then that might actually negatively impact your returns in the long run. So you do have to observe the risk level of the unit trust by looking at things like the volatility and also, for example, the Sharpe ratio, which is a measurement of the risk-adjusted return. Okay, and on top of that, I would say that you want to ensure that your time horizon is appropriate. Often, I do see investors invest in unit trust thinking that they can make the return within a few months. That's actually quite unlikely to happen. In fact, if you invested anything this year, more often than not, you probably be in the rate at this time. Okay, so in the long run for unit trust, you really do need to give that enough time for unit trust to get the returns that you're looking for. And we are not actually talking months, we are talking about like years here. Yeah. So Darren, maybe you want to add something?
Yeah, I'll want to quote one of my most favorite investors, that's Warren Buffett. I think when it comes to factors, it's about, so what Warren Buffett says is never invest in something you don't understand. So I think it's very important to understand what you're investing in, just like what both Darren and Elijah has shared, right? Every fund has its own specific and different investment objective. And yes, it's not that easy. Sometimes the investment objective can look the same, but a different fund manager can have a very different investing style. So these are things that you probably just need to dig a little bit deeper. But in terms of factors, I think it's also about choice, because there's a lot of different types of funds. Maybe in the past, investing or unit trust is quite straightforward. It's an equity fund, buys on stocks and shares. There's a bond fund, buys on fixed income. But what we sort of noticed a trend recently are thematic funds. What I mean by thematic is invest in a theme. Example, invest into artificial intelligence or invest into disruptive stocks, right? So these are then like a subset. So it sort of gives you even more options. There's even what we call value-based investing these days, because there's a lot of focus on sustainable investing. So it could be investing in a strategy, or I don't want to invest in energy companies. I don't want to invest into dirty industries, right? So that there's different options. So I think when you're looking at unit trust, it can be a very fun journey. It's about finding out, hey, yeah, what's important to you, what's not important to you. And then you'll notice that there's actually a wide variety. It's like a big library of choices you can have. and then you can pick and choose and put it in a portfolio. Yeah, thanks.
Thank you. Thanks, speakers. I think what I got out from the sharing just now is that actually selecting a unit trust does not have to be such a daunting task. As the saying goes, knowing is half the battle already. So by identifying your investment goals and your risk tolerance clearly, I think you've already overcome the biggest hurdle. So speaking of risk tolerance, let's move on to the next another poll. Yeah, let's do one last poll. So I will flash and read out. This is the poll. If you're on Facebook, you can comment in the chat. If you're on Zoom, just click your answer. Yeah, we just want to get to understand our audience a little bit better. Yeah, let's give it a while. Okay, so yeah, I think that's all. So majority has chosen equities followed by multi-assets. Then we have bonds, cash. Oh, some people believe in FD, and not sure. We still have a bit of not sure. Yeah, okay. This is just to get to know you a little bit better. That's all. Yeah. Let me carry on with the question. Okay. Yeah. Okay, given the current market conditions, this is quite straightforward. What are your views on investing in unit trusts? Yeah, any of our speakers would like to go first?
Maybe I'll go first on this end.
Okay,
I
thanks,
think
Darren.
the poll was very interesting. It's good to see actually quite a fair number of you are want to invest in equities in the next 12 months. Current market conditions this year, one of the worst years in markets. If you're investing and really whether you're investing in stocks or bonds, you're pretty much losing money. Probably only if you're investing in commodities and oil, you're not. But even then, that's so volatile, right? In the last 1 week, oil prices dropped 10%. I think I probably just want to share at Schroders, we do have a view that recession is pretty much at our doorstep. We do think recession, particularly in US, Europe, UK, is going to hit the markets very soon into 2023. But probably my view on your investing in unit trust is then this is also where is a very interesting time because markets have fallen so much. And maybe you will start hearing, and a lot of us are also, of course, worried about recession, we keep our jobs and things like that. But from a valuation point of view, this is also where markets are looking. It's like a balloon and it's lost a lot. You sort of pop the balloon. Instead of an inflated situation, is really looking a lot more attractive now. So I would say, for those of you who are investing in unit trusts, maybe you're also feeling really terrible on the markets, feeling terrible on your investments. I would say probably for those of you in this group, selling off your investments is definitely a bad idea. I think sometimes we do hear from clients, hey, Shrai, well, if you say inflation, recession, will markets fall further? Maybe sometimes some of you would think, hey, should I sell and then go and buy at a lower point? But the thing is, it's very difficult to predict markets. So I would definitely advocate not selling off investments at this current point of time, and rather look back at your time horizon. I do think if you do have that risk appetite and time over the next 3 to 5 years, it is a pretty good time to start looking at investing. But from a type of investing, I would say probably a little bit something more diversified, multi-asset, probably something a little bit more fixed income. So we could still see some weakness in equity markets. So yeah, but sorry, taking out a bit too much time. But over to you, Darren and Elijah.
Okay, so I think this is an interesting question. Naturally, as an investor, I also have a unit trust portfolio myself. But one thing is for sure, I'm definitely staying invested right now. Okay, but I'm also doing dollar cost averaging through the current market conditions, right? So as I mentioned, unit trust, right, that has strong fundamentals, right, will actually probably have a very good chance of recovery when the markets and the economy picks up again. So as Darren mentioned, we don't have that crystal ball to tell the future, right? So I'm not going to try and time any entry or exit, but instead, as long as I keep to certain fundamental principles when I'm investing, which is namely, of course, to invest in money that I don't need okay, and invest with money that I can afford to lose, then I can just continue to do my dollar cost averaging. And this will help me to write out the current volatility in this current market juncture, and also remove any effect of fear and greed on my portfolio. So, every month I just do my dollar cost averaging, and I'm not really trying to attempt to find a good entry price or anything like that. Yeah, so I think I'm staying invested for sure. It's just that, of course, with the markets dropping, of course, I would think people might start to feel a little nervous, but that's actually quite natural. Yeah. Darren, Chew, back to you.
Okay, Ken. I want to add that when it comes to investment, actually, we need to be optimistic, okay, over the long term. As we need, if you don't believe that market long term will go up, then actually you should not really start investing. Okay, at current market juncture, because I see a poll, actually a lot majority are looking at equity for the next 12 months. Okay, actually, I actually more concur to that. If you are looking at long-term time horizon, when the market bottom this month, nobody knows. We only know when the market is bottom after market start to rise. Then we say, oh, there is a bottom. Okay, because nobody will able to predict the bottom. So it may, at this juncture, I say that it may be a good time actually to really start to invest slowly. As what Elijah said, this year, dollar cost averaging actually is a very good way to invest now. Okay, as you are starting to invest gradually, and ultimately the market will recover. What I need to do is just need to stay your course and ignore the noise. Okay, that's like in my YouTube channel, actually I got a life portfolio. I show my unit trust portfolio. That's why I just check. Year to date actually is down 19%, but I still doing dollar cost averaging every month. Okay, on that. Okay, just to show long term why actually you will definitely make money, provided you choose the right fund from the start. Okay, back to you on Justin.
Okay, so I see that all of our speakers actually point out that something in common is that if you have a longer time horizon, 5 years or more, then it's good to stay invested while dollar cost averaging in good funds, as they have actually maybe a good chance of recovery when the market picks up again. Yeah. Okay, so one. So I think right now what we can take away about this about investing in unit trust is that a little homework and a due diligence will also go a long way to increase our chances of success. And picking a winning unit trust that suits your portfolio. If we do not, but you know what, if you do not have time for that, you do not have time to do all this homework because we are so busy with our hectic lives in Singapore, right? So maybe you can talk to a financial specialist, you can talk to Darren, Elijah. Yeah, so before we move on to the Q&A section, I would just like to welcome you to connect with Phillip or with any of our financial specialists tonight. You can scan the QR code, their link is there. If you want to reach out to Darren Ng, his email is right there. I think we got a panel tonight who, they are actually very passionate about sharing and broadcasting value-added financial tips and views to their customers and their followers. Yeah, I'm sure, I'm also sure that Darren Chew here is also growing his team and is welcoming like-minded individuals to join him. So for those who are enjoying webinars like this one and you would like to stay connected with us to receive more updates, you can give us a like on our Facebook page. It's facebook.com/Phillip Wealth Advisory, or you can simply scan the QR code. And if some of you here with us tonight can potentially see yourself becoming like our financial specialists like Darren and Elijah here, please feel free to visit our website, tinyurls.com/pcatontrep, ENTREP, and check what's in it for you and drop us a message if you'd like to find out more. Yeah. Okay, now let's get on with the Q&A section. I see a lot of questions. So we'll be opening up to the floor now. We'll try to clear these questions here because it's getting late a bit. But if you have any more questions, you can also put it in right now. We'll try to get the speakers to answer them. I think our speakers will do their best that they can to answer them. So let's have the first question here from Yu Chuan Ko. Thank you for the question. What is Sharpe ratio of unit trust? Is it important? Any of our speakers would like to take this question?
Maybe let me take this question. So Sharpe ratio, right, is actually something that measures the risk-adjusted return of an investment. So naturally, you will want this kind of ratio to be positive. So that indicates that you are getting more returns for a certain level of risk compared to, say, something else that you're comparing against. For example, maybe the another fund. So for example, when you are selecting funds, right, you will be able to compare their Sharpe ratios, and that is just one of the many factors I will find that you will want to use in your selection. So a fund with a better Sharpe ratio, assuming all things equal to the other fund, that means that fund actually give you better return for the same proportion of risk. Yeah.
Thanks, Elijah. So important. Yeah. Okay. So we have another question from Samuel Ong. Some US unit trusts are available in USD and SGD. Which currency would you pick to invest in and why? Darren, you want to take this question? Any of the two Darrens?
I think to make it quite straightforward, particularly in Singapore, because most of us at least are earning Sing dollars, and that's why even at Schroders, and you see the options you have in Singapore is mainly in Singapore dollar denominated. So even if you're investing in a US unit trust, or it could be Europe, etc., you typically will have the option to invest in a Sing dollar share class. And my own preference is I want to minimize foreign currency movements. So I would typically choose a Sing dollar share class. But saying that, there will be some of you who maybe want to invest in US dollars. But my perspective is then you're sort of taking on a different level of risk, because you're not just investing in the underlying assets of the unit trust, you're also investing potentially in the gains or also the corresponding a loss, let's say, of US dollars, because your US dollars is going to fluctuate against your Sing dollars, right? So that's sort of adding on that second level of risk. Yeah, but so simply saying, if you want to keep it simple, probably just look for the Sing dollar or Sing dollar hedge.
Okay, thank you. Okay, we have a question from GK. How do dividends affect the investors' holding and the NAV of the unit trust? Darren, you want to take this question? Thanks for the question, GK.
Actually, how do dividend affect? Actually, when a unit trust, okay, do think that we'll come back to dividends. When you buy a unit trust, not like buying stocks where the stocks declare a dividend, you get a dividend. But when you buy a unit trust, the dividend can come from multiple sources. Okay, it can be really from the dividend on the underlying asset the unit trust fund manager have invested in. Okay, it also can be from a capital gain. And sometimes it can be also from return of capital, but that it will be more rare. So if the dividend is really from return of capital, then you may see a drop in NAV. Okay, but you see, long-term wise, all the NAV for a good fund, even they continue to pay dividend, their NAV is supposed to go up over time. Okay, but you see that's like XD, sometimes the dividend will drop a bit, but after long term, the dividend will still go, the NAV is supposed to go up if you are looking for capital appreciation for growth dividend funds. Okay.
Okay, thank you. Okay, we have a question from Elaine C. Thank you for the question. Does a fund that regularly make distributions consider a good fund? Can a fund make distribution from its previous year's earnings or from unit holders' own capital, even if it is posting negative returns currently? Elijah,
let's add on to that. The fund that make, as I mentioned, the fund can be really from its own distribution, also can be really from capital gain. So you should look at the total return as a whole. Don't just purely focus on dividend. Ultimately, we also look at total returns. If you collect high dividend, but net you still have a total capital loss, then it will make sense for you to invest. So what you want is a reasonable dividend with a reasonable capital upside. And this is why I always talk about total return in that aspect. I don't know whether there are two want to add on that.
Elijah, you want to add, right? Something.
I was actually going to
Elijah
talk about the total returns thing, but Darren has mentioned it already. So yes, we do want to look at your total returns, because there's no point you take, say, 4% dividends, but then the fund drop 10%. So you're still losing money, right? But of course, in this current market juncture, funds that are paying dividends are still paying on dividends, but they are also declining in NAV, but that is because of the market. So as mentioned earlier, please don't think about it in the short-term basis. You have to look at the long-term. Do you believe that this fund will continue to do well once the market actually recovers? Yeah, so that's what I wanted to say.
I also just want to add on, I think is dividend paying funds is quite local, it's quite Asian, because I think for all of us on the call, there's one thing we want. We want to get paid regularly, but we still want the thing to grow in value, right? We want the best of both worlds. So coming back to Elaine's question, I think it's also whether maybe you should be asking, do you need a fund that pays you dividends? Because if you don't need the cash flow, then actually maybe you don't necessarily need a fund to do that, right? So it's a bit hard to say whether it's a good or bad fund, but yeah, I totally agree. It's more important to look at total return. You don't want a fund that's paying you 4%, but it loses on its value at 1-2% a year. Yeah, so I think this is something all of us can definitely agree on. Yeah, back to you, Justin.
Okay, we have another question from Jason Soon. Thank you for the question. Is it true that unit trusts are all long only, or some unit trusts can short or even use derivatives strategies? Any of our speakers want to take this?
Yeah, I probably will share it from Schroders' perspective. It's broadly true that unit trusts are long only, but the second part of your question is also true. So at Schroders, for example, we do have strategies that have future positions, equity futures. These are derivatives, so we can actually technically short the markets. But I think it's not to the magnitude that you will see in, for example, hedge funds. Okay, I don't want to go into that for today's webinar. That's a totally different topic. But yeah, generally it's long only, but we can take tactical views to protect the portfolio. I hope that helps.
Thanks, Darren. We have a question from Isaac. This one, Elijah actually passionately told me, before we did the webinar, when we were still talking, he said that, if there's any questions coming about T-bills, Justin, I want to answer them. So we have one for you here from Isaac Tan. Does dividend fund still make sense with T-bills at 3.7%? Elijah, go for it.
Okay, Isaac, firstly, thanks for the question. So I think you got to look at your time horizon, right? A T-bill is 6 months, maybe at most 1 year. So yeah, you could squeeze out that 3.7% per annum from the T-bill at this current juncture. But we also need to remember one thing is, do you think that this 3.7% is going to last for the next 5-10 years? Probably not. I don't see how the interest rates can continue to remain so high. So if let's say you're looking at something short term, this is like, for example, monies that you don't need in the next 6 months, maybe because you're saving for, say, a house rental or something, and the money is just there, but you don't need it now, then sure, maybe the T-bill could be a place you park it. But if you're talking about long-term dividends, regular dividends over the long term, then I wouldn't think a T-bill is the right asset class for this kind of income streams. You have to look at other assets. So for example, like unit trusts, they pay dividends, as long as the fund is there, they're paying dividends. You have stocks and REITs, they also pay dividends, and that's over years. Or even you have things like annuities, which pay you income for life. So ask yourself, I think, Isaac, ask yourself, what is the purpose of this money, and what's your goal for it? And you should be able to know whether a T-bill is the right fit for you or not. Yeah.
Thanks,
maybe
Elijah.
I want to add on that
yeah.
for T-bills. Okay, T-bill now is 3.7% because interest rate is rising. If you were to check the T-bills records, okay, from April 2020 to March this year 2022, that means for the past 2 years, the T-bill return is less than 1%. It's only the last 6 months the T-bill then start to rocket up. So T-bill is only 6 months to 1 year. After that, 6 months, 1 year later, will the interest rate come down? Most likely, yes. So that is for short term. But you're looking at long term, then a dividend paying fund may fit for your long term objective.
Okay, thanks,
Justin, over to
Darren.
you.
Yeah, okay. We are at 9 already, so I'll just take another 1 or 2 more questions. Okay, we have one from Yu Chuan Ko. Is unit trust that are using option strategy means higher risk? Yeah.
I'll try to answer this as well.
Thanks, Darren.
Short answer, no. Actually, because for example, the fund I mentioned is a multi-asset fund. It's very diversified. So actually, in terms of volatility, it's actually very low. So not necessary. Yeah. So it really depends on of course, if it's a different strategy that's using significant amount of options, it can be high risk. But for depending on how you manage it, it can be low risk.
Okay, thank you. Okay, one last one we have from Jeffrey Lee, a very simple question. So many UTs, how to choose? So any of our speakers want to just, I know we shed some light on this in the earlier questions, but maybe you guys want to highlight something on how to choose these so many UTs. Yeah.
I'll leave it to Darren Ng and Elijah because my answer is very biased to show this. No, I'm kidding.
Okay, maybe let me start with this one. So of course, there are a lot of factors, right? So for example, returns. Okay, as Darren mentioned, you got to look at funds that have a good track record over a number of years. So that's one thing. Second thing is, of course, even if there's a good track record, do remember to compare among the peer funds in the same category, because what if there's a similar fund, similar sector investing in the same sector, but is performing better over the long run. So naturally, if the risk factor is the same, then you want the fund that does better, right? And then another thing also, for example, would be your fund size. Okay, you don't want a fund that's too small. Okay, but you also don't want a fund that's too big relative to the market, because that can also be detrimental. So quite a number of factors actually, but I know we're running out of time. I'll let Darren Chew talk about some other factors as well. Darren, over to you.
Okay, maybe I just want to add one more thing is, don't just purely look at return. By return, we always look at total return. You also need to look at the risk, which I always call the volatility on the unit trust itself. So you need to look at a fund may give you a 15% return compared to a fund that give you 10% return. But the 15% fund, the fund manager may take higher risk and the volatility may be even 18% higher than the returns. But the fund that give you 10% return on, the volatility may be only 10%. So you also need to look at the volatility aspect, especially when during market downturn. We are not in 1 standard deviation volatility. We are actually in 2 to 3 standard deviation, and you may get knocked out by the market if you can't take that type of risk. Okay, so this is my point to add on that. Okay, Justin, over to you.
Okay, thanks to our speakers. I think we're running a bit late, so thanks for all the questions from our audience. A lot of good questions, a lot of nice, good answers from our speakers as well. Yeah. Okay, so I think that it has been quite an. Hold on. We'll just wait for a slide to come back on. Okay, yes. So as I was saying, it has been quite an eye-opener listening to our 3 guests tonight. I think I have certainly learned a lot. I hope a lot of you have been learning, especially the beginners here, have been taking a lot of mental notes for myself, and I will apply it to my own UT investments. So at this juncture, I also want to welcome comments on what kind of topics that do our audience wish to hear in our next Ask Me Anything series, as your input is valuable to us, and we strongly believe in equipping our clients through education, just like what our speakers are doing here tonight, so that you can better plan and make informed financial decisions. So now we will have our speakers wrap up by just giving some key takeaway points for investing in unit trust. Yeah, maybe Darren Chew, you would like to go first.
It can. Okay. When it comes to investment, I always emphasize it needs to be boring at times. Okay, so that you have to be patient. And if investment to you have a lot of excitement, okay, then there's a high probability that you'll lose money. Okay, because you may make decisions based more on emotion rather than logic. So thus, don't look at the market or listen to the news so often unless you are a trader. So have a long-term view is a key, and just review your investment regularly, rebalance it when necessary, and lastly, just ignore the right noise and just ride the wave. And dollar cost averaging, I would say that will be the way to go for a long-term investor. Okay, maybe Elijah, you want to add on?
Sure. Okay. So firstly, just because everyone says that, you may have heard this, saying that everyone is saying that unit trust underperform that's not actually true as I highlighted. Okay, it is definitely not true for all unit trusts, right? There are definitely unit trusts that will outperform index, as I mentioned earlier. Okay, so these kind of unit trusts are the ones that you want to be invested in because they generally tend to offer superior risk-adjusted returns. And secondly, unit trust is just one part of a well-balanced portfolio. Okay, you must not forget there are also other asset classes out there that can also complement your current financial portfolio, right? So ultimately, I would think that when it comes to holistic financial planning, you will have to pay careful attention to your asset allocation, which is to say how much goes into unit trusts, how much goes into stocks, how much goes into safe products like annuities and retirement plans, so on and so forth. So that would be also one key takeaway. Maybe Darren, you want to wrap up?
Yeah, I'll leave everyone with a statistic. I think this was something I wanted to share earlier about misconceptions. I think we always sort of will think like, oh, when we invest CPF, because our CPF ordinary account delivers 2.5% returns, right? I'm just going to share a statistic. This is from CPF board. It's on their website. You all can go and look for it. The data is as of September 2021. So last year, not now, all right? But if you have been, so this takes into consideration all of the 500 over 1,000 CPF members investing in their CPF. Even in the past 5 years, the number of people who are making profits, in short, making more than 2.5% per annum on their investing is actually 70%. So I think that's quite a good statistic. But yeah, I think it comes back to what we've been sharing today. Clearly, you need to be finding and selecting the right funds to be investing in, because the other 30%, then the next 10% is making 2.5. The bottom 18% are losing money, right? They're making less than at 2.5. So selection definitely still is very important. So hope that helps everyone. Back to you, Justin.
Okay, Ken, thank you for the key takeaways. All right, we have come to the end of the session. It's 9:09 now. I would like to thank our three remarkable speakers for their sharing, and a big thank you to everyone who has stayed with us thus far. So do keep a lookout for our upcoming Ask Me Anything episode. If you guys have any more questions, feel free to reach out to our speakers. Yeah, so see you all and good night. Yeah, bye.
Good night. Bye-bye.
Bye, everyone.
Good night.